Hello, FEDCAP family. I'm Keith Reid, the supervisor for work readiness instruction here at the Pole Grand Concourse location of FEDCAP in the We Care program. And once again, I'm here and want you to join me on this Financial Friday where we discuss things that will help you best know where to invest your hard-earned money, where to save, the best places to do that. So in today's lesson, today's session, I want to cover, believe it or not, I want to cover life insurance. I know most people don't think life insurance is a financial service product or a financial aspect of their lives. They're wrong. It is. And let me explain why. As someone who once sold insurances, I can tell you that if you're in a situation where you don't have, we're not even going to discuss, do I have enough money for a burial? Let's talk about the other aspect of a person's life when someone passes away in an untimely fashion. So you pass away, or someone in your family close to you, your wife, partner, husband, spouse, you pass away in an untimely situation, especially in this COVID-19 period. Anything can happen, right? So someone passes away, and all of a sudden, the family begins to realize after the burial, there's not enough money to continue to keep the household running in the shape, form, and fashion that the entire family was used to when the key breadwinner was alive and earning an income. The question then is, what do you do? Do you pass a hat around to the family members saying, can you give me money so that I can pay the bills and continue maybe sending the children to a good solid charter school or private school or whatever? These things do happen. So insurance, life insurance, is as important for you as it is for you to have on your car, your vehicle, or a house if you own a home, right? And matter of fact, why would we go through all of the trouble of making sure we have auto insurance or we have home coverage insurance, but not life insurance? And we're just too often not taught as we come through the school system, right, in America, not just New York City, but in America, that having life insurance is an important thing. Let me tell you, it is an important thing. And when I sold life insurance at some point in my career, one of the things is we knew it was life insurance, but we also sold it as income protection. Income protection. We must protect the income of the key breadwinner or winners in our household. I would often ask a family of, say, 3 children, husband and wife, 3 children, and a dog, right? I would also ask each one of them, if something happened, Mr. Smith, if something happened to Mrs. Smith, would you want to continue to live in this home, right? And continue to raise your children in the fashion that you and the children are accustomed to? Yes, 100% of the time. Mrs. Smith, if something happened to Mr. Smith, would you want to continue to have this home and send your kids to the schools you send them to and continue to live in the lifestyle that you and your husband set up and that you're accustomed to? Absolutely 100% of the time, the answer was always yes. But after I would go through their financials, I would find that they were woefully underinsured from a life insurance standpoint. They may have a mortgage outstanding on a home they've been in, say, 10 years. They may have $250,000 left to pay on that 30-year mortgage. But without at least $250,000 to cover Mr. Smith or Miss Smith, you couldn't pay off the house and pay off debt, and therefore, in the absence of the spouse who passed away, you wouldn't be in a situation to be debt-free, which is what you should be considering when you sign up for a life insurance policy. It's to put the spouse, the surviving spouse, in the position where they are debt-free if anything happens to you or your spouse. Debt-free. That's why having a solid life insurance plan is important. And there are a couple of types of life insurance. Let's talk about annuities for one. An annuity is an investment, but it's also a kind of a hybrid kind of insurance policy where you have the death benefit, but you also have the investment component as a part of the policy. It's a contract, right? And you have those two things blended together. There are good, solid annuities out there. And one of the things you want to look into as you begin to shop for different types of life insurance is, would an annuity be the right fit for you? Now, understand that when you have an annuity, you don't have a lot of the upfront tax benefits you would if you opened a traditional IRA account or if you saved in a 401k plan. In other words, the annuity can grow tax deferred, which means when you draw down on it at 65 years old, you pay taxes on the income that you're generating from the annuity that you've paid into over the years. But that's about it. It grows tax deferred, but it doesn't offer you any kind of front end tax benefits. What's a front end tax benefit? Here's one. All the contributions made into the annuity are tax deductible, but they're not with an annuity. That's the point. So that's what I mean when I say upfront. But when you contribute to your 401k plan at work, those contributions are tax deductible, hence the upfront tax break you get. Plus, when you invest in your 401k plan at work, that money, like an annuity, grows tax deferred. You don't pay taxes on it until you retire. Plus, you have the match, right? You have the corporate match coming from your employer. So the employee contributes and the employer contributes. Usually the ceiling is 5%. So if 5% of your income goes into your 401k plan, then the company may match that with 3 additional points. Hence, you're saving 8%. You meet the 5% threshold, the company will match that with 3% of their own money into your retirement account, by the way. Hence, the money is growing at 8%, growing at an average of 8%, right? Contribution rate. All right. So those are the different kinds of, that's one different kind, I should say, of an insurance program, and that's the annuity. What's the upside to an annuity? Well, your income is protected. Now, we all know that when you invest, there's no guarantee that the way the economy is performing today, it's going to perform in the future. So when you invest, you're taking a chance that you will not only make money, but you have to realize you may lose money. One of the good aspects of an annuity is that the principal that you put in is protected. So you can you're pretty much guaranteed that you'll get your principal back and whatever little interest you've earned over the years. So that's a good solid point. So when the market crashes is another good point. When the market crashes, and they do crash from time to time, the annuity, again, is something that's kind of immune to the market crash. Since it is a contract, what it commits to in the contract to pay you over a certain period of time, it will do that regardless of what happens in the economy or what happens in the market. Plus, the insurance company backs it up. Since the insurance company is selling the annuity, they back it up. So if there's something going wrong in the economy on the market and it takes a nosedive like it did in 2008, 2009, 2010, those folks who owned annuities pretty much were okay. That's the nature and structure of owning an annuity. Lastly, the guaranteed death benefit. No matter what happens, if it's supposed to pay you $100,000, if the key breadwinner passes away, it'll pay $100,000. So those are 3 or 4 good reasons you would want to look at an annuity as a part of your financial services plan and planning and your portfolio. All right? But understand, it does not have some of the upfront tax benefits that other types of retirement accounts pay out. An annuity is essentially in a retirement account as well as an insurance policy. And it just has some very nice aspects to it to protect your income and protect your principal. It just doesn't come with some of the tax benefits. And those are very important and not to be pushed aside as unimportant. Now let's talk about whole life insurance. And I'm going to fast forward on my notes. Whole life insurance is just that. You pay premium your whole life. That's what a whole life insurance policy is. So most of us know someone, grandma, grandpa, auntie, uncle, mom, and dad, who have a whole life policy, this cash value component. Now the cash value component is the savings part. So you have the insurance plan, and then you have this part of the insurance plan where you save money in the insurance contract itself. It is not, repeat, it is not a good way to invest your money and grow your investment portfolio. In fact, it's a very poor way to do it. You don't save for your future. You shouldn't save for your future, right? You should not invest for your future in an insurance plan. You just shouldn't do it unless it is an annuity where you have some guarantees that your investment is protected. In a whole life plan, it's not protected at all. It's an insurance plan with a savings component, and they pay very, very, very low rates of return to you as the investor. And the cost per thousand, quick lesson about insurance, the way the rates are set up. What you pay per $1,000 of coverage on your life is how insurance basically is set up. So it could cost $1.19 per $1,000 of coverage, right? That's how life insurance plans are structured. Well, whole life insurance policies, they're very expensive, very expensive. So if you have $10,000 in coverage, you might be paying $3.50 per $1,000 of coverage. Other types of insurance plans, you might pay something as little as 89 cents. I've seen them where you've paid as little as 89 cents per $1,000 of coverage. And it's a good, solid, that 89 cents per $1,000 of coverage is a good, solid plan. There's nothing funny about it. It's a good, solid plan and type of insurance to own. And you can keep the difference between the $3.50 and an 89 cent and invest that in the market and make more money that way, and still end up with the insurance coverage you need should someone pass away untimely. Whole life is just a very, very poor way. Whole life policy is a very poor way of investing your hard-earned money. You could invest the difference in a mutual fund. And then there's term life insurance. People go, oh no, Mr. Reid, I don't want term life insurance because it's a contract where I 10-year term, 15-year term, 20-year term, 25-year term. And when the term is over, I'm still alive. I paid all this money in insurance and I didn't die. Well, I think that's a good thing. And if you are, let's say 20 years older, you can always reestablish a new term life policy, cheap in cost again, right? And cheap in per $1,000 coverage. Right? You're older, so then you bring down how much life insurance coverage you need. You may not need the same amount of life insurance coverage 20 years later. You may own a home. You may have invested properly. You have other types of investments that you've invested in whereby you don't need the same amount of life insurance you did as a younger person just starting out in his or her career. Now you're more established. You have things that you can leave to your heirs, and you don't need insurance to cover it because you have built up a solid investment portfolio for yourself over the 20 years. Hence, when you get to the 20th year of your term life insurance, you just bring down the coverage, bring down how much premium you pay every month, carry just enough to pay off debt, bury you, and leave all of the other assets you built up in those 20 years to your heirs. So those are the different types of insurance. You have an annuity type of insurance / investment hybrid. Then you have the whole life insurance program where some of you, as I've said, and I've seen it with my own grandmother, where you pay premiums forever. My grandmother, just as a backstory, is now 101 years old. She sent in her last life insurance premium 2 years ago when she was 99 because she would not listen to me, right? And get what I would have preferred her to have. She stuck with what she knew, given her generation and who she was comfortable with. Okay, Grandma, I'm not going to argue with you or fight with you, but she's a case study in the kind of premiums that insurance salespeople love to sell because you pay forever and those premiums you pay are expensive, and they give you very little coverage, by the way, but very little, great big whopping premiums every month, and then the death benefit is like down here. And that's what I want you to understand, as insurance, life insurance being a part of your entire investment portfolio and your plan for your life. So you have, and then you have again the term life insurance, where you have a contract for 10 years, 15, 20, and 25. Give you an example before I close. Give you an example of a 35-year-old man, non-smoker, wanted to take out a $500,000 life insurance policy under a term life plan. The cost to him was $35 a month. So he could afford that probably 5 times that amount, right? He could afford 5 times that amount. But he got $500,000 in coverage for $35. A $500,000 whole life insurance policy would have cost him $150 a month. You do the math. $35 a month, $150 a month. You do the math, right? So as you can see, life insurance, and I want you to come away with understanding this, life insurance is a very, 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 very central component to your entire investment, financial plan, portfolio, your picture. Don't discount it as something that you have to think about simply because you're thinking about it in the sense of someone passing away, because people pass away. That's reality. It happens to all of us in our families. That's real. So you need, the essence of this session today is understand it, accept it, understand it, and prepare for it the smart way. And consider investing your hard-earned dollars in insurance programs that are best for you and that return a decent rate of investment to you. If you're going to put the money out, you ought to be able to get something long-term. You ought to be able to get something out of it. So again, we have annuities as one plan. We have whole life insurance as another plan, which we do not recommend on this session today. And then you have term life insurance, which I do recommend based on how efficient it is from a cost standpoint for all of you as customers out there. So that's what I wanted to cover with you today as a part of the Financial Services Financial Friday series that we run here at FEDCAP at the Grand Concourse office. If you have any questions, again, I'm Keith Reid, the supervisor for Work Readiness Instruction, and you can always email me any questions you may have about any issue we've discussed in any one of the 18 sessions that we've had since April of 2020. I can be reached at kreid, that's K-Reid, R-E-I-D, at fedcap.org at any time. You can send me an email and I'll be more than happy to respond to any questions, comments, concerns that you have regarding anything we've discussed in our Financial Friday series. So I want to thank you again for listening and taking the time to listen. And we have many, many other types of videos on our website. So you can always access our POE BX website, Work Readiness website, anytime you want. And you can find a host of different kinds of training snippet videos that will help open the door to your understanding about an assortment of things, not just finances, although personal finances are important. Again, thank you very much for listening and taking your time out to be with us today. And I look forward to seeing you the next time on our Financial Friday series. Thank you very much and have a great day.